I don't think you're coming back to 50 bucks silver or $2,000 gold or anything like that. I think enough fundamentals in the world will have shifted at that point to where, once again, gold pretty soon everywhere becomes money again. I think we're in the process now of moving back up. I think you get much back up in the 80s on silver, especially ever touch 90 again. We've rallied to 90 four different times after that drop and been sold each time. If you ever go back there again, they're gonna blow your head off. I've been quoted many times, $300 to $500 silver very rapidly, like within 3 or 4 months after clearing this congestion zone. Nipped out 2 prior highs of the last 11 years on that spread chart, the relative performance chart. When we run GDX versus gold, it didn't quite break out. So basically the broad miners measured by XAU or GDX divided into gold, plotted, shows a 11-year wide base at still very cheap levels compared to history, and they're pushing for a breakout. Holy heck, you know, what's going on here?
We have seen gold and silver sort of being stuck in this range for a while now. And of course, some people say, well, gold and silver is building the base, getting ready for the next move. But also others believe that, well, we have seen something similar, a big move in gold and silver in 2011, and we know what happened then. So what would be some of the other reasons, Michael, why you believe we will not repeat the 2011
Okay.
scenario?
We use our momentum methods, and particularly what we're looking at for major trends is long-term momentum factors, not just week-to-week, day-to-day stuff. Okay. We called the top 3 months after the 2011 high. Gold had gone up eightfold between 2002 and 2011. Same dimension of bull market that it had in 1976 to 1980, briefer period of time, but an eightfold move. Right now, we're only four to 4.5-fold gain since our bear low in late 2015. So we're not even matching those 2 prior bull markets in terms of percent gain. Yet everybody's screaming because they're looking at their arithmetic dollar denominated charts and it looks like it's vertical and all that, yeah, etc. Put it on a logarithmic scale and you'll see what I mean. It's not parabolic. We've had a 3.5-month congestion zone. The drop really occurred in one day. That was January 31st. You go back and look at your daily price charts and you can see it on silver and gold.
What looks like a blow-off top on retail charts often isn't even close on a long cycle basis. Michael Oliver notes the current move is still far below the eightfold surge that defined prior true exhaustion phases. That matters because arithmetic charts create emotional panic, while logarithmic structure often shows compression, not collapse. If investors mistake consolidation for climax, they can exit before the strongest expansion phase begins. Next, Michael Oliver reveals why one ignored momentum signal separates healthy congestion from a real secular top.
It was like 95% of the drop that one day. Okay. And since then, you can draw a line sideways. And you go teasing each time, like try to go up, can't do it. Try to go down, can't do it, etc. Right now, we're about smack in the middle of the stuff, especially on silver. We think based on intermediate. Oh, by the way, I mentioned the 2011. Let me get back to that. In 2011, the reason we turned bearish is massive long-term momentum trend structures. When we plot long-term momentum, like annual momentum of gold, it blew a multi-year uptrend structure that you could not see on a price chart, but you could see it on momentum. There's like 8 points on this line. Unbelievable line. Any kid with a crayon looking at our charts could have seen that line. Okay. And it broke it in January of 2012. And it labored for a full year and a quarter until the spring of 2013, never able to get back to its high, ever. And finally, you crashed. April, May, June time period 2013, and went on down to $1,050, meaning got cut in half, okay, by 2015. But it gave an annual momentum alarm bell because it was a very clear structure. There is not one now that is even in jeopardy, even in close proximity whatsoever. So that entire drop we just saw, silver and gold, in no way threatened their long-term dynamics. The only thing it threatened was intermediate trend factors, things that come and go and several months or so. And once you break me, I'm going to take you down for a couple of months, not for a couple of years.
The market can fall violently without actually breaking what matters. According to Michael Oliver, the 2011 collapse was confirmed by annual momentum damage that simply does not exist now. Price alone fooled most investors then, and it still traps people who confuse short-term weakness with structural failure. For wealth holders, misreading intermediate volatility can mean selling long before capital rotates back into hard assets. Next, Michael Oliver exposes why momentum breakdowns often appear long before headlines admit a bull market is over.
Okay, and sure enough, that's all we've gotten. This is and then sideways. We think it's a launch pad for the next move, and we think based on more near-term metrics that this advance we saw from that March 23rd low. The March 23rd low was a cleansing final low. What did it do? On a price chart for silver and gold, what they did in late March, 3 weeks into that war, they sold off and took out the February price low, the initial collapse low, February 3rd, I think it was, one day after that January 31st collapse. They took it out. No doubt ran all the sell stops. And a lot of people probably said, if you ever break through that Feb low, I'm gone. Okay, they broke through the February low. And silver spent 2 hours below it and then rocketed back up, like, laughing at them. Okay. And then as now, we're 75, 76, 77 as we're speaking. And that low was $61 on March 23rd. I think we're in the process now of moving back up. I think you get much back up in the 80s on silver, especially ever touch 90 again. We've rallied to 90 4 different times after that drop. Been sold each time. You ever go back there again, they're going to blow your head off. And I think what silver is going to do on the other side of this congestion is something totally vertical. And there's a lot of reasons for it. And
false breakdowns often punish retail right before stronger reversals begin. What Michael Oliver is highlighting is how stop-loss sweeps can flush weak hands while preserving the larger bullish structure underneath. A brief break below prior lows followed by sharp recovery often signals liquidity hunting, not genuine collapse. For metals investors, that difference matters because institutions often accumulate while public fear spikes. Next, Michael Oliver unravels why repeated resistance failures near major levels may actually hide explosive upside pressure.
I've been quoted many times, $300 to $500 silver, very rapidly, like within 3 or 4 months after clearing this congestion zone. So that's what we're looking for. Gold will also have a very strong move, but it will be vastly beaten by silver.
Right. So if this does not happen, Michael, let's say in 6 to 12 months, so let's say gold continues to stay in this range, would that be a very bad sign? Could that mean the end of the bull market in that case?
Our metrics say that won't happen, but if it did, no, it's not a top. The problem is the long-term momentum metrics, annual momentum of gold, are just nowhere near touching levels that would break the spine, the uptrend dynamics of the annual momentum. So it would just be a prolonged range-bound situation. We've had these before on the way up. You can go back to 2015. Since then, you'll find quite a few of these things that are a year wide, maybe even 2 years wide. I don't think we're in that condition again. I think we're beyond that. We're now in the acceleration phase of these bull markets, meaning more turf is gained in a much shorter period of time, which is not uncommon in dynamic bull markets that have gone up for years and finally just have a tantrum at the tail end. And by the way, once it peaks or reaches the next new reality, I don't think you come back down. Yeah, you'll have sharp corrections.
A stalled market can feel safer than it actually is because patience often disguises acceleration. Michael Oliver's argument suggests that even an extended range would not automatically invalidate the larger bull trend if long-term momentum remains intact. That directly challenges the mainstream habit of calling every delay a failed breakout. For savers protecting purchasing power, confusing consolidation with exhaustion can mean missing the phase where metals reprice fastest. Next, Michael Oliver reveals why prolonged sideways action can still hide the strongest secular advance.
But I don't think you're coming back to 50 bucks silver or $2,000 gold or anything like that. I think enough fundamentals in the world will have shifted at that point to where, once again, gold here, there, pretty soon everywhere becomes money again. Even governments start to acknowledge it, back their currency by gold. Uh, why? Stability, predictability. Fiat stuff has not worked. And once you go into the next economic crisis, I think academicians and public alike will realize, hey, something hasn't worked.
Yes. So after we have this big move, Michael, you partially answered this question already, but of course we would need to have some sort of consolidation, and you don't believe the gold price is going
Mhm.
to the original levels. But could that consolidation be for years to come, or do you believe after the launch there'll be another base, and after that gold could go even higher?
Oh, could be, but I think the events, the fundamental events, the headline events, reality-based events, not transient things like war comes and goes in Iran, or even the Ukraine thing, or the tariffs, uh, will be so dramatic and so painful to too many people to where political upheaval will also occur. And I'm not on one side or the other in this. I'm just saying this is likely to happen. And already we're seeing evidence of it, even in the US. Two-party system, we think that's some kind of institution that lasts forever. It wasn't here forever. It's been around for 100 years or so.
What gets dismissed as a metals rally can become a direct referendum on trust in fiat systems. This is where Michael Oliver's thesis shifts from price action to structural confidence, where gold's role expands when monetary credibility weakens. Markets often treat political instability as noise until it starts reshaping capital behavior and reserve priorities. For long-term savers, that means the biggest risk may be assuming yesterday's monetary framework remains permanent. Next, Michael Oliver exposes why political fracture can accelerate hard asset repricing faster than most analysts expect.
But basically, neither party right now is in a very good condition. In fact, my bet is it'd be hard for either party to get a majority. In other words, they're so fractured. The Democrat Party is broken. They don't know whether to go radical left or try to find some central route. And in the recent primaries, we just saw no more radical left people done. Put into office. And the Republican Party is totally fractured. The old Goldwaterites, Reaganite, conservative types that used to be the backbone of the party, they don't like Trump. Not just on policy, but other things. And so a lot of these guys have simply retired from office or not participated anymore. And that party is now a Trump party, and whether you like it or not. And but it's narrowed like the Democrat Party in terms of the base. And wouldn't it be interesting if we end up with third parties that actually have power now? Meaning, like in Europe, one of the big parties needs one of the minority parties to actually take office. They need some kind of coalition. Don't be surprised that kind of event occurs. Don't be surprised that certain institutions are come into doubt because of the nature of the crisis that people are experiencing at that point in time, meaning later this year, especially. Uh, will the Federal Reserve always be there? Or will they finally decide, hey, this 110-year-old institution is it's just been a generator of boom bust crises, not stability, et cetera. All kinds of things like that could happen, are likely to happen. And therefore, the same with gold and silver. Once they go to a new reality.
Institutional stability often looks strongest right before public trust begins cracking. Michael Oliver notes that political fragmentation can become more than social noise when it starts undermining confidence in long-standing financial structures. The deeper issue is not party politics, but whether stressed institutions still maintain credibility while central banks defend stability narratives. For investors, erosion of trust can quietly redirect capital toward assets outside policy control. Next, Michael Oliver reveals why institutional doubt may affect gold and silver faster than official messaging admits.
Are more and more acknowledged as real money, then they take on a different reality. Roosevelt took action against gold, and then about domestic, and then Nixon cut it off from international backing. So, Democrat and Republican made gold illegal in effect. Okay, and so that could be reversed because of the consequence. But anyway, all these things can happen. I can't predict which ones, but I bet a lot of them. Things that people aren't talking about, but will be talking about once they realize, holy heck, what's going on here? And so that's the reality I think we're facing down the road. And I think gold and silver are ahead of the game. And by the time the average investor, average analyst starts to realize the nature of what they're dealing with here, not just another bull market, already at that point, gold and silver will be like 70% of the way to where they're going to go anyway. You missed it. The real headlines don't come out till late in the bull trend. They rarely come out, Anyway.
You made some excellent points, Michael. If we could touch on mining stocks. So, mining stocks are still stocks, and you believe that stock market could have a lot of weakness in months and possibly years ahead. So, could you see a situation where the metal, the commodity, continues to perform higher, but miners lag even more than they have in the past year because of weakness in the general equities?
By the time public headlines validate a trend, most of the asymmetric move is often already gone. According to Michael Oliver, precious metals may front-run broader recognition because monetary stress gets priced before mainstream consensus catches up. That is the contradiction retail often misses. Markets move on positioning, not public understanding. For capital preservation, delayed awareness can become expensive when investors wait for comfort instead of evidence. Next, Michael Oliver unravels why miners may diverge sharply even if metals keep climbing.
By our technical metrics and by just general pricing of miners as a category to the stuff they get out of the ground. The miners expressed as a percent of the price of an ounce of gold. For decades, the XAU index, which goes back to the 1980s, Philadelphia Gold and Silver Miners Index, was trading at a valuation to gold of, on average, 25%. In other words, you divide XAU price into the ounce of gold, and it was 25% of the ounce of gold. It had a range for decades between about 35% on the upside and about 17.5% on the downside. So it would do this for decades, 1980s, 1990s, 2000. It wasn't until 2008 that spread broke down, meaning the miners relative to gold were no longer holding at that general level, that relative pricing level. They collapsed from that average mean of 25% to 4%. That was in late 2015 when gold and the miners actually bottomed net price wise. That spread had collapsed to 4%. Something that used to be for decades, on average, 25%, went to 4%. Do you know what cheap is? You think it's going to go to free? Okay. So miners are vastly undervalued to that which they get out of the ground for various reasons, not always logical. Sometimes they're errors. Markets overprice and underprice themselves, often in excess. Well, anyway, for the 11 years since that 2015 low, that spread has been in a range between lows at 5% and highs above 8%. Like that. Very narrow range, and we're pushing at the upper end of that range. In fact, for XAU versus gold,
an asset can stay historically cheap long after the crowd assumes value has already returned. What Michael Oliver is highlighting is a valuation gap where miners remain deeply compressed relative to the metal they produce. That disconnect raises a harder question. Are institutions ignoring miners or quietly waiting for relative breakout confirmation? For investors, undervaluation alone means little until capital rotation begins. Next, Michael Oliver exposes why a narrow relative range could become the trigger for aggressive upside repricing.
Nipped out the two prior highs of the last 11 years on that spread chart, the relative performance chart. When we run GDX versus gold, it didn't quite break out. So basically the broad miners measured by XAU or GDX divided into gold, plotted, shows a 11-year wide base at still very cheap levels compared to history. And they're pushing for a breakout. Our assessment is based on momentum, they're going to break out. And when that spread breaks out, and I think that will occur coincident with the gold and silver coming up out of this range they've been in, I think the miners will punch through that relative performance level. They will gush on the upside. The miners will gush in relative performance. I think they could double to triple their value to gold very rapidly. And what that tells me is that the investment public and large asset managers who don't necessarily want to buy silver bullion or silver futures or gold futures opt for the miners, especially the biggies like Newmont, so forth.
Breakouts rarely look obvious until relative strength has already repriced fast. Michael Oliver's argument suggests that an 11-year base in miners versus gold could matter more than spot price headlines dominating financial media. If large capital wants metals exposure without holding bullion, miners become the institutional shortcut most retail ignores for portfolios that can create outsized upside, but only after momentum confirms participation.